Hi everyone, I'm Artur, one of your hosts at Reimagine 2020. Today I have with me Nate Hindman from Bancor Protocol, one of the earliest AMM or liquidity pool protocols around. So definitely excited to hear about Nate's background, Bancor's background, and what's to come. Welcome, Nate.
Thanks for having me. Really good to be here.
So, I mean, let's dig right in. Can you tell me a little bit what is Bancor and what do you do?
Yeah, so Bancor is an AMM protocol. By AMMs, we mean automated market makers, or some people call them liquidity pools. But it's essentially a new way to build exchanges from the ground up, where the liquidity can come from anyone, as opposed to traditional exchanges where they're professional market makers that run order books. AMM liquidity pools or automated market makers run fully just based on code. So traders are trading against code. The trades are managed by on-chain token reserves. And it's really a way to build sort of a new form of decentralized exchange, which is, like I said, where the liquidity comes from everyday token holders as opposed to professional market makers. And so that's what Bancor Protocol really is.
Got it. And you guys have been around for quite a while, right? 2017, if I'm not right.
Yeah,
if I'm not wrong.
Yeah, so Bancor was sort of building on the primitive and had this idea of deploying automated market makers on Ethereum in early 2017. And then the network went live in June 2017. So you could say it was one of the first, if not the first, DeFi protocols to emerge.
Got it. And I guess, and to a sort of, to a rookie user, it is from a usage point of view or a functionality point of view, it's similar to Uniswap, right? But with the key difference being that there is Bancor has a token, right?
Yeah, so it's very similar to Uniswap. Uniswap was heavily inspired by Bancor. Essentially, each automated market maker, the most common form is they have two token reserves. One is the sort of base token that is being provided liquidity, and the other token is an intermediary token. So say in the case of Bancor, I wanted to trade between DAI and let's say, give me a token, SNX.
Sure, SNX.
DAI and SNX, that the trade would essentially go from DAI to BNT and then BNT to SNX. And that would be trading between those two liquidity pools, one being the DAI paired with the BNT pair, and the second being SNX paired with BNT. Then Uniswap came along and built these liquidity pools with ETH in their reserves. So it would be DAI and ETH or SNX and ETH. And then what we sort of realized as the years went on is that any asset can be paired with any asset. And so in Bancor, you can pair any two pairs. It doesn't have to be BNT. And likewise in Uniswap, it doesn't have to be ETH. It can be any other reserve pair. But something we really discovered that was sort of key in our own evolution is that users, when they're holding a token and they want to provide liquidity to that token in the liquidity pool, they don't necessarily want to split their token into the reserve asset. They want to hold their 100% long exposure. So really a key part of Bancor v2, which is just in its beta phase and coming out of its beta phase in the coming weeks, hopefully, is to have 100% single token exposure. So as a liquidity provider, you can provide liquidity, say, to the SNX pool and retain your 100% exposure to SNX without splitting it into BNT and taking on exposure to BNT, or without taking on exposure to ETH. Because we found that when you take on exposure to another asset in the reserve pair, it can create some pretty complex risks for liquidity providers, where they can find that providing liquidity can lead to them being worse off if they just held the token on its own in their wallet. So we can dig into some of those risks and some of the features of V2, but it's important to establish the sort of basic structure of the kind of AMM or liquidity pool.
Absolutely, and one of the risks that I think you described was the impermanent loss, right?
Definitely, yeah. So that's just a a really kind of the biggest challenge that AMM pools are facing today. In addition to not being able to retain 100% exposure to the token, it's this idea that if you're staking liquidity inside a pool, the prices of the assets in the pool can move such that when you pull the asset out, so when you exit the pool, you're worse off than if you had just held the tokens or the token on its own in your wallet. And so up until now, the real bet that liquidity providers have been making has been that the fees that are generated by each liquidity pool will be greater than the impermanent loss that you suffer on your tokens. And so by fees, I mean each time a trade is processed by a liquidity pool, it generates a fee that the trader pays. So a trader trades against a pool, let's say in that SNX BNT pool, they make an SNX trade, it'll take a percentage of the trade. Now in Uniswap, that percentage is fixed at 0.03% of each trade. In Bancor, you can set, the pool manager can set the fee to any fee that they want. And so the higher the fees, the more the trades will cost for the traders, so there'll be less volume, but then the higher the profitability there are for liquidity providers who are staking their tokens inside the pool. So it's really finding that sort of key balance between bringing in enough volume and having it being compelling enough for traders, and also having it generate good returns for liquidity providers. The way these pools work, and I know I'm kind of rewinding a bit, is that the higher the liquidity there is in the pair, the lower the rates of the conversions are. So the lower the slippage that you will get charged as a trader. So the key is to really attract a lot of liquidity inside the pool. As the liquidity goes up, the slippage that a trader will suffer will go down, and the more volume you can generate, the more fees you can generate for the liquidity providers. So the key issues that our new version, Bancor v2, is really trying to solve is, one, the single token exposure, and two is how do we mitigate the risk of impermanent loss for liquidity providers? How do we ensure that even if there's very dramatic shifts in the prices of either reserve asset, how do we make sure that the liquidity providers really aren't getting sort of so-called wrecked, which is really the case in most existing AMMs today? Is that clear?
Right, and I'm sure it's kind of it's happened to many of us. First of all, that when I have wanted to, for example, provide liquidity to a pool on Uniswap, then the first discovery point is that, oh wait, like I need to hold two assets. Okay, right, and then you kind of then you figure that out, and then you kind of, and then afterwards, you never really know what you're gonna get out until until you actually take it out, right? And
yeah, I mean, really I guess what's kind of happening behind the scenes is we're seeing a massive transfer of wealth, really, from liquidity providers who, like you said, don't have too much visibility into the returns that they're generating, and can often see when they pull out that the liquidity is worth less than if they just held it. And you ask, well, who's making that money? Well, the answer is arbitragers. So arbitragers are really key to how AMM pools function, right? Whenever AMM pools are completely disconnected from external markets, right? They don't automatically update based off of some price feed. What happens is if someone trades against a pool, an arbitrager comes in to make the opposite trade and really balance out the pricing. As you trade against a liquidity pool, it changes the prices that it offers the assets at. So arbitragers play a very key function in this ecosystem in terms of balancing prices. So really what we're seeing in the AMM ecosystem right now, and it's kind of below the radar, is as you say, a lot of these liquidity providers are losing tons of money, and you wonder, where is this money going to? And really there's a massive sort of transfer of wealth that's happening from LPs, liquidity providers, to arbitragers who play a really crucial role in balancing out prices in these AMM pools. But at the same time, sophisticated traders are coming in and extracting value from these liquidity pools. And it's really coming at the expense of LPs and in the form of impermanent loss. So we're seeing the vast majority of trading that's happening on AMM pools is really these arbitragers that are coming in and taking advantage of these price inefficiencies. And the structure of the pool is set so that the LPs can really, if there's a decent amount of volatility in the markets, can really end up suffering quite a great deal. And the winners in this case are the sort of arbitragers. And so a real key feature of V2 that we really set out to build was, how do we set up an ecosystem where arbitragers can play this crucial role of balancing out prices and making sure that the pool is offering prices that are aligned with the external market prices. But how can we set up a system where the LPs aren't losing so much money and forking over so much of their liquidity to these arbitragers that come in and really create this large amount of impermanent loss in most cases.
And these arbitrages are essentially arbitraging between centralized exchanges and the pools, I'm guessing then, or?
It could be any place. It could be, actually most arbitrage we probably see is between other dexes, whether they're based on order books like 0x, or they're based on AMMs like Uniswap and Bancor. So there's a lot of arbitrage that happens between those protocols, and there's also a lot of arbitrage that happens between centralized and decentralized exchange protocols. So really anywhere an arbitrager can buy, high and or buy low and sell high, and use the AMM pool as a sort of base for doing that, they will do it. And again, this is a crucial part of AMM pools to balance out the pools, but they're designed in a way that the LPs are giving up too much to arbitragers, and there needs to be a redesign such that arbitragers aren't able to make so much off the backs of LPs. And we think we have a model with Bancor V2 that really allows LPs to protect themselves against seeing their stake go to nothing, because there's nothing worse than, say, being long on a token and say, I want to be long on a token. It's my favorite token project, or one of my favorites. I also want to provide this service to the token project, which is to provide liquidity to their AMM pool. In so doing that, I'm creating this sort of liquid on and off ramp that allows users to trade in and out of the token with more ease. It's cheaper to do so. So I'm long on the project, right? But with the current AMM structure, if say the token price really shoots up a lot in the external market, the AMM pool is selling off that token as it's rising in price. And the arbitragers are coming in and extracting value from the pool. And so, the interests of the LPs should really be aligned with the token project, such that if there's a massive spike in the price, they shouldn't lose a lot of their money. It shouldn't be selling off all their tokens from the pool. And so this real effort with our V2 is to ensure that if you're long and you're also providing liquidity, that you're not going to end up just giving up all your holdings.
Right. So, I guess, are those the two kind of main value propositions for the V2? Is that, first of all, I can deposit a single asset, and secondly is that I'm protected against impermanent loss?
Pretty much, those are really the two kind of key assets, and it's designed more so towards these sort of long-term token holders, because kind of what we've seen in today's market is we've seen the emergence of yield farming, where protocols are essentially giving away free money and they're dropping this yield on their AMM pools, whether it's in Bancor or Uniswap or Balancer, and essentially saying, if you stake your liquidity, your tokens in this pool, we're going to give you a certain amount of free money over a certain amount of time based on how long you've been in the pool. So this is effectively in some ways masking the issue of impermanent loss, because you're hoping that not only the fees can cover your impermanent loss, but also that that the yield farming will, that the free tokens that you receive will. The thing is that giving away free money is not really that sustainable, right? So inevitably, it's the new sort of yield farmers that show up at a protocol, are able to stake very quickly in the AMM pool, and are able to, at the right time, pull out before the sort of yield farming fees or the yield farming that's dropped on the pool dries up. So in order to avoid impermanent loss. And then also what we're seeing with a lot of these protocol tokens in these sort of copy paste forks is that the token can dump pretty quickly after the yield farming rewards dry up. So as this kind of long-term holder, someone who wants to participate in farming, you have to get into the pool at the right time. You have to get out of the pool at the right time. You have to ensure that the protocol token of the yield farming protocol isn't just taking a massive dump right after the, sorry for the language there, but right after the yield farming rewards dry up. So it's kind of created this new type of, let's say, Deegan, they say, the like degenerate yield farmer that is constantly monitoring their farms, constantly shifting in and out of pools. And it's sort of taking us away from this sort of long-term token holder that just wants to set it and leave it, which was the original kind of promise of AMMs. You might as well, if you're holding your tokens in your wallet, you might as well put them to work. You might as well generate the sort of long-term interest on them and hold them in the pool without being subjected to this massive risk of impermanent loss, without having to give up your exposure to the token. And so that's what we're really designing V2 for, is, we recognize the importance of, generating super high yields, but we also recognize the importance of mitigating risk inside these AMM pools, and that people can't, people have day jobs. Not everyone is a full-time farmer. Not everyone has access to sort of the advanced tooling that it takes to properly manage your yield versus your impermanent loss and all that. So it's really a sort of set it and leave it solution. And we're really designing it too around rewarding yield farmers that are able to stake their liquidity inside the pool for a certain amount of time. So the sort of longer that you stake it inside the protocol, the sort of more you're being rewarded. And we think this sets up an incentive design that really avoids the sort of short-term, they call it kind of hot money liquidity that's just bouncing from protocol to protocol. Because as I'm sure you've seen, as a liquidity protocol or any protocol, as you turn on your liquidity rewards, you get a flood of liquidity providers. And as the rewards go away, it's not sticky for the liquidity provider. They're just going to go to the next, the next, the next. And sort of we're in this constant cycle of new protocols popping up, new yield farms popping up, the whales and the sophisticated traders getting in there fast, sucking up all the rewards and then moving on. And it's at the stage where it's not truly innovating on kind of the underlying primitives. It's more just innovating on the sort of yield farming and the token distribution, which is crucial and is truly innovation in terms of a growth marketing hack for liquidity providers to bootstrap liquidity. But you really need your liquidity providers to stick around in order to make it sort of, I guess, more accessible to the kind of long tail and the retail users who, are also token holders. So I know I went
right. And I guess no one has, I guess even crypto can't achieve sustainable 2000% yields, right? That has been kind of pretty sort of unsustainable dream that we've been living for the past sort of couple months.
Yeah, and I think.
But tell me, so how do you guys do it then? Let's get into it. Is there a simple kind of a way to explain how does the let's say the single asset pool, how does it work?
So unfortunately, we were at a stage where we released a beta of the V2 and have had to do some redesigning in order to release sort of V2.1. So the beta was totally crucial for us in learning the mechanics of how the pools work, really a sort of testing in production type phase that we've been in. And we've taken a lot of these learnings, and we've really made some pretty serious redesigns to the model. And so the sort of redesign and the full kind of specs of that will be coming out soon. But sort of given the kind of competitive nature of the AMM space right now, I can't share too much on the model for how the mechanics work. But I will say that it's kind of truly unique compared to a lot of the sort of copy paste AMM protocols that we've seen, like I've said, that are really, I guess more so innovating on the token distribution side, on the yield farming side, and haven't really designed an AMM structure that can effectively mitigate impermanent loss or can really allow for single token exposure. We haven't seen that. A lot of, we were the first to come out with V2 with the kind of the idea of these features. And having been in the AMM space for so long and realized these pain points, we sort of realized that it was a place that we truly needed to focus and offer these features. And so since then, we've started to see a lot of noise about people that want proper impermanent loss mitigation, they say single-sided liquidity or single token exposure. We haven't seen an effective model come out yet. There's been some tries. We feel that our upgraded version of our V2, we're calling it V2.1, which we hope to be out quite soon. I can't give any specific dates, does truly deliver on these badly needed features. Unfortunately, I can't dive too much into the mechanics of it at this stage, but there will be a period of discussion prior to the audited code going live. So we will be sharing the sort of full specs on the solution, and at that stage, I hope you can kind of reshare it with your audience, and anyone can kind of come to Bancor to sort of see how everything works under the hood. I think a real interesting paradigm that we've had to face is how do you build a moat in DeFi? Like given that everything is open source, everything is forkable, how do you design a system that encourages liquidity providers to stick around? Because like you said, the 2000% API, APY or APR is truly not sustainable. It'll just lead to you spending a lot of your token, having very high inflation on your token, which your token holders suffer from, and you're really just giving away free money to liquidity providers that will just go to another protocol the second the rewards start dropping, and your sort of long-term token holders, the people you care about most in your community, are sort of left holding the bag. We've kind of seen this happen a little bit with SushiSwap. We've seen it happen with a number of the sort of so-called food coins. And we've really designed our V2.1 to encourage liquidity providers to stick around and to reward them for sticking around. So to ensure that we're not really, blowing all our money on LPs that are just seeking the high rewards and just float to the next protocol. You can kind of think of your liquidity provider rewards as sort of like ammo or gunpowder, right? You only have a certain amount, and the key is to utilize it at a point where you can generate enough sort of demand for your service that the demand outstrips the cost of inflation to your holders. And so that's really what we've sought to nail, is this resilience against forks, against so-called vampire liquidity attacks, and to really build a moat around our liquidity that allows LPs to really stick around.
Got it. And I know that one other way that Bancor kind of stands out is that you guys are not only Ethereum specific, right? You also have a relationship with EOS. Is the V2 expected to also be available on EOS then, or?
So it's not just EOS. Bancor's a multi-blockchain. Since we
Uh-huh.
use a protocol token, and what's really unique about our AMMs is the protocol token exists within every pool. So there's other AMM protocols like Uniswap or Balancer or Curve that have a protocol token, but the protocol token doesn't exist within every pool. So you end up with a bunch of different reserve assets. And in the case of a lot of these other protocols, it's the native blockchain token, ETH, that is the reserve asset. So it requires multiple hops between pools in order to get to a separate chain. And because Bancor uses BNT in each one of its pools, it's never more than one hop to a separate chain. So say I want to go into, let's say, Polkadot, for instance, Polkadot chain. I can go from the base token, let's say DAI, to BNT on Bancor, then wrapped BNT on Polkadot, and then into the dot token. So it allows Bancor to more freely operate across blockchains because we have this intermediary asset that's not ETH. Essentially, the goal really is to once we nail the core AMM structure and make it resilient to impermanent loss and allow for single token exposure, is to expand the model in the second phases of V2 to different blockchains, and that could be EOS, could be Polkadot, it could be any number of chains, but we definitely see that DeFi is not something that's while it's home and the core DeFi innovation is really being piloted, I'd say, on Ethereum. We see all sorts of utility, especially when it comes to high throughput and transaction fees on other blockchains. So it's totally crucial that once we validate the core AMM structure, that we move as fast as possible to implementing it on separate chains. And we already have the infrastructure with Bancor's cross-chain bridge that's already live, connecting EOS and Ethereum back and forth, that can be adapted to other chains. And also, and not just other chains, but to Ethereum layer 2, to ensure that our layer 2 integrations are compatible with layer 1, and that we're not sacrificing the sort of composability that you get on layer 1 by integrating this sort of L2 solution.
Right, and that was actually going to be my my next question. That I guess one of the reasons why we're so much talking about even competing blockchains is the kind of ever so increasing Ethereum congestion and gas prices, right? And this has very heavily impacted obviously the AMMs and the DEXs and so on, and especially their customers. What are your kind of what are Bancor's kind of views on that? How has it impacted you, and how are you kind of approaching this scalability dilemma?
Yeah, it's a massive issue.
So you mentioned level 2s, for example.
What's that?
You mentioned level 2s, for example, and
yeah.
What are you guys sort of thinking there?
Yeah, it's a massive issue, and it's not just for traders. Traders obviously are facing the high gas costs, and if they want to go in and out of tokens, if they want to do that, but it's this increasingly important case of sort of use case where you're providing liquidity to the AMM, and if you have to factor in sort of massive gas costs to enter the pool and also to exit the pool, which can be more gas intensive transactions than just trading, then as an LP it can also really affect you too. And so the high gas fees are an issue for both traders and also for LPs. And we see layer 2 integrations is totally crucial and on our roadmap. But really the key is how do we how do we integrate with an L2 and make it so we're not stuck on an island with only being able to be composable with other DeFi protocols that have built on that L2, and how do we ensure that L1 DeFi protocols can easily interact with Bancor's pools and can easily build on Bancor's pools, even if there's not an integration with that L2 service. So I think that the interoperability between L2 and L1 is totally crucial and something we need to see. But Bancor is moving forward full steam with an L2 integration, and it's something you should see shortly after the V2 goes out live in full release. And we're excited to get a sort of proof of concept out there and to really see the bridges built between not only L2 and L1, but also different L2 solutions.
Right. I mean, excited to hear more about that in the future. Then, what are your thoughts on, for example? So we've spoken obviously a lot about liquidity pools and AMMs. There's been recently, this, I guess, kind of resurgence of order book based DEXs, or one particular one on Solana, so the Serum network. What are your thoughts on how do you view the kind of order book based DEX versus a liquidity pool?
I think at the end of the day, the real advantage that AMM pools have over order book based DEXs is as a liquidity provider, the sort of idea that you can just set your liquidity and there's no minimum amount of liquidity that you need to contribute. There's no real, the technical barrier is super low. So the capital barrier is super low. The technical barrier is super low. And then as a liquidity provider, at least in the sort of true vision of AMMs, is you don't have to constantly monitor your stake. And so this was this innovation that allowed anyone to be a market maker. And I think where order books will always suffer in terms of building the amount of liquidity that AMMs can build is that order books just inherently require an active market maker. So someone who has enough capital, someone who has the technical efficiency to run a sort of market maker on an order book based system, and someone that also can monitor it and can constantly make sure that the prices it's offering on the order book are profitable. And so I think AMMs will always have this advantage. And I think we've seen as AMM-based DEXs have totally, overcome and increased beyond order book-based DEXs. I think by a magnitude, a huge magnitude. All the biggest volumes are happening on AMM-based DEXs right now, and I think that's really
absolutely
drives to the point of that. When your liquidity comes from the crowd as opposed to a small group of highly technical and wealthy market makers, that you can really build better liquidity. At the end of the day, liquidity is king. If you have more liquidity, then you can offer more competitive rates. So there's tons of other benefits that you get from a trader's experience from order book based DEXs. And I think there's a lot of interesting experimentation that's happening now that's sort of blending order books and AMMs and especially with aggregators that are able to pull orders in real time from both AMMs and order books. But at the end of the day, I think the advantage and the real innovation of AMMs is that liquidity can come from the crowd. They can be community owned exchanges where, and I think that really drives to the ethos of DeFi in and of itself, that when you are able to offer financial services like exchange from a large group of people as opposed to this wealthy, small, elite class of, technologists, I think you end up with just more liquidity. and more efficient models and more interesting ownership structures, especially doing order books. I guess another benefit of AMMs over order books too is the level of transparency you can get from an AMM. The fact that everything can be on chain. So you can distribute the revenue that's generated from trading perfectly fairly, because you know exactly who was providing liquidity and when and for how long, and you have this fully on-chain record of that. Whereas with order books, doing fully on-chain order books is not something that's really been achieved at scale. And so achieving the sort of same ownership dynamics is also, I think, a big challenge to order book-based exchanges competing with AMMs. But, you know, I see a world in which probably both exist, and it's not a sort of zero-sum game, and different sort of blending of both the exchange structures is definitely going to happen, and definitely kind of ripe for innovation there.
Got it. Good answer. I know you're super busy, and we're kind of slowly running out of time here. I just wanted to, I guess when we talked about your kind of vision as well for the industry. I'd just be interested to know, what are the kind of the things that you're most excited about in DeFi specifically, and the things that you're least excited about?
Wow, that's a tough one.
Can start with either. And you can't say Bancor.
Yeah, sure. So most excited about, I'm really excited that we've gotten to a stage in terms of open source and composability that the DAO and governance infrastructures are set up such that we can finally design community-owned protocols. And I think that's really the power. And we've only really seen it come to fruition. You know, DAOs were a big deal in 2017, 2018, but they sort of never lived up to their hype. And finally, I think, you know, at the core of the most successful DeFi protocols are really an engaged community, and a community that can come up with the best ideas, collectively coordinate and organize around them, and really get them passed and get them built into these protocols. So I would say that the governance layer in DeFi is extraordinarily exciting. Bancor's governance is coming any day now. We have our DAO launching very soon. And we've found that some of the best ideas and some of the smartest minds that we end up working with on whether like a part-time or full-time basis, working directly with the core team, just come from random, you know, from our Telegram chats, just people that are super fascinated from the community that can, you know, crunch our data better than we can, that have better ideas about, you know, the AMM pricing curve than we could ever have. So to really harness the collective wisdom of the crowd is something that's super exciting, and that's forming, and we find the infrastructure to do that with the governance layers that we have. So I'd say DAO and governance is what I'm most excited about. God, there's not a lot in DeFi that I'm not excited about. You know, I'd say on one hand, you know, the sort of Deegan, greed, casino, YOLO mentality has been it's kind of got a bad name, and I guess some might refer to that as sort of like, listen, we got into DeFi for democratizing access to financial services, and we got like Deegans and food coins. But so and we got, you know, just like a casino, which with all these wealthy, you know, connected crypto traders and VCs, just kind of like, you know, basically a kind of casino based on that. I do see that though as a really important step in getting towards this ultimate vision for why a lot of us got into this game, which it was to democratize financial services, and I guess the sort of classic, you know, bank the underbanked. We need the Deegans and we need the greed because not only, you know, I guess the biggest reason is the infrastructure for this stuff is really, we're in a creative destruction environment where stuff is getting forked and attracting billions or hundreds of millions in, a matter of hours. And it's allowing the pace of innovation to really just go into hyperdrive. Like everyone in DeFi knows that this past few months has just been like mind-blowing, like the extraordinary pace of innovation. And a lot of it is because the sort of emergence of the yield farmer and the Deegan, which who have a very high tolerance for risk. And it allows protocols to launch with, say, unaudited code for things to get hacked. We wouldn't want to pilot this type of software on underprivileged or impoverished populations that need access to these financial services the most. You sort of need this degenerate YOLO yield farmer to really
to be your QA testers with real money.
Exactly, to be your sort of guinea pig. And some of them are doing quite well, some of them are not, but it's a super important phase. So, I think I'll often see that sometimes there's some animosity towards this sort of emergence of this new type of DeFi user, but I think it's a crucial sort of step in the evolution of the space. And, and I'm
I guess it's kind of similar to this, we had this phase of, which I'm sure like almost no one remembers anymore, this, this period where flash loans would just like, wreak havoc left and right? Like, when the sort of, when they were being used to kind of, just destroy, different like lending pools and protocols and just like, exploit some like, tiny, fractures that some protocols did have. But we kind of got through it and don't really hear that much about it anymore.
Yeah, it's this mentality of sort of the anti-fragile thing. You need to have a system repeatedly attacked in order for it to build up this kind of resilience. And I often say to my non-crypto friends who are like, oh, well, crypto is mostly used by like criminals and, tax evasion, like what's the utility? Where's the banking of the underbanked? And, I often say that, you might have heard this before. It's kind of been cliche at this stage in the industry, but it's like any truly disruptive and innovative technology will be used for both good and evil. And when email first showed up, there was all this sort of email spam and send money here, and people potentially getting ripped off left and right. But we didn't shut down email, or we didn't sort of shift innovation away from email. We set up, spam filters, and now today it's, far less of an issue. So we've been in that phase for crypto for some time, and now DeFi is having its moments of, as I say, creative destruction and plugging the holes, and flash loans is a great example of that. And so, I think it's becoming a more anti-fragile system. And like I said, I'm glad we have these risk-tolerant users to sort of be guinea pigs.
Got it. And I guess what is Bancor is also playing an important role in the kind of the evolution of the industry. What does Bancor need kind of help with the most from its community or the wider DeFi industry?
Yeah, I'd say we're on really the bleeding edge of innovation with automated market makers. So anyone who's interested, and I often find that some of the best minds in AMM shockingly come from non-financial backgrounds. Like for some reason, there's tons of people that are former physics PhDs or people that were physicists that were very high level there, who are really interested in this AMM primitive because it sort of mirrors a lot of, traits of sort of things in the natural world. So we need as many kind of brilliant minds as we can developing this new form of automated market maker. And really, anyone who wants to join our Telegram groups, Bancor, or I think it's just /Bancor is the Telegram group. We're also opening up a Discord and a Discourse. We have a lot of really brilliant minds working on on solving the issues with AMMs. And anyone who really wants to sort of demo the new v2.1 pools that are coming out, soon you'll be able to provide liquidity, and you'll be able to do so, like I said, with 100% exposure to a single asset. So it will support any ERC20 based asset. So if you own ERC20s, it's likely that we'll have that pool live on Bancor, and you can stake it inside the automated market maker contracts and really get a feel for what it's like and give us feedback, and hopefully generate some pretty interesting yield from the pools. So those are generally people that we'd love to engage with. And I really think Bancor is the leader in sort of building the most advanced AMM pools. So I think it's an interesting opportunity, to the extent that this is one of the most interesting developments in crypto today, the sort of the AMM primitive, to be able to be a part of the sort of the evolution of the next phase of these primitives, I think is super interesting. So I think that's our big ask from the community is, if you want to think about, model, or participate as a liquidity provider in these pools, we hope you'll engage with us.
I mean, ask who you shall receive, right? All right, two very, very quick questions for you, Nate. I know you got to run. In your opinion, do you think ETH 2.0 staking will come out by the end of this year? Yes or no?
My guess is hard no on that. I'm thinking more so early 2021, I'd say so.
Hopefully.
Yeah.
And if you had to describe DeFi in one word.
Let's go with access. And that's not just access for the end user, which I can take my MetaMask and plug it into any DeFi protocol. That would be equivalent to me saying, let me plug my debit card into any bank and get access to its financial services in a couple clicks. So it's not only access from the end user's perspective, but I think also from the liquidity provider's perspective, and also the chance for them to have collective ownership and own a piece of each one of these protocols and really dictate their roadmap and have collective control over upgrades. So access really across the spectrum from end users to real ownership, I think is the sort of key thing that comes to mind when I think about DeFi.
Sounds brilliant. All right. Thank you so much for your time, Nate Hindman from Bancor. Super excited to definitely see the upcoming version 2. If anyone's, as you mentioned, if anyone's interested to try it out, hit up Nate or the team on Telegram. And I wish you a great remaining part of 2020, Nate.
Likewise. Thanks so much for having me. Really appreciate it.